right, so we'll start the session. So, hello everyone. My name is Vikas Agrawal. I'm the founder of AIF and PMS Experts India. So, I'm glad to share that we are now emerging as one of the largest digital platform for AIF and PMS in India. At AIF and PMS, it is our endeavor to sort of organize these knowledge-based sessions, and some of you might be attending our sessions for quite some time and might have observed that we believe in educating the investor community as a whole and empowering them with more knowledge and wisdoms. So therefore, we keep organizing these webinars, and today we've invited Arpit Shah from Care PMS. So the whole idea of setting up this webinar is to understand more from them in terms of how do they run their PMS strategies and what are their views on the market. So let me just take a minute to quickly introduce the group Care PMS. So Care PMS is set up in 2011 with a team of chartered accountants. So they were seasoned investors. They had their passion towards equity and entrepreneurship. So they sensed immense amount of opportunities in Indian equities. And prior to setting up this, they were more of a seasoned investor. So they used to invest their own money, and therefore they have complete skin in the game. So whatever money they have put their money in PMS. So it's a team of 4 people. So Arpit heads the team, and he's the main brain behind it. And surprisingly, is that most of the team members, while they have been they're involved in managing the PMS, none of them comes from a background of PMS or background of a capital market. So all of them were new to this industry, and they had the passion of creating wealth for their investors. So therefore, they started this business. They are now managing about 300 and odd crores in the PMS. So Care PMS is one firm where promoters are fully involved in the core activities, which is research and portfolio construction. Let me also introduce Arpit here. So Arpit has, I think, more than 15 years of experience in the industry. Uh, he's one of the founder and the director. So I would say he's instrumental in terms of setting up the entire investment philosophy at Care PMS. Uh, he was, he had this idea of starting a PMS, so he always believed in taking the risk, and therefore, he thought of coming out with a PMS idea, and he wanted to create wealth for his investors. So while he was creating wealth for himself, he thought of, allowing the public money also to come in and start managing money, and started delivering the returns in the hand of investors. So he's able to deliver good returns in the hand of investors. So I welcome him on the show of Ask the Expert. So welcome, Arpit.
Thank, thank you, Vikas. Thank you very much. First of all, I thank AFPMS to have me here. It is my privilege, and just wish you, your entire team, and all the participants of very good health. Hope they all are safe. Thanks for very kind introduction of Care PMS as well as for me. Just to should say one line that about risk taking. So this business was not about the risk taking; it was about building the bridge. So
Sure.
we were doing fantastic on the equities on our own, and
Okay.
we understood that people were not having that kind of knowledge or temperament. So
Uh-huh.
we thought that okay, then we can certainly bridge the gap. Uh, as far as I'm individual concerned, yeah, I am a kind of a risk taker. So my still few crores of portfolio, but I have only 5 to 6 large investments. So that is my personal. But at Care PMS, we have very well diversified
Okay.
companies and portfolio.
So
Yeah,
Arpit, tell us how did you? What was the reason of giving the company name as Care PMS? What was the logic behind it?
so it was taking care of the money of the investors. Actually, company founded in 2007. Okay, so in 2007, and then we had Lehman crisis and other things, and before that also, people were not actually taking care of their money. They hard-earned money. They were very much, the tip-based trading हो गया या कोई अच्छी FNO में position बना ली तो वो हो गया. So there was not people were not alert or were not taking care of their funds.
Yeah.
So that's why we thought that okay, at least for name our company as a Care PMS, and
Okay.
yeah, that was the idea behind it.
So, Arpit, just take us through your investment philosophy or the stock selection process. How do you select these stocks in your portfolio?
Yeah. So basically, broadly, we are bottom up. We apply bottom up approach. Uh, we are sector specific. We are agnostic. We are open for all the sectors and all the market cap companies. Uh, but our major focus is on growth stocks with right valuation. So we have been delivering very great returns only because we could identify some of the great companies at very early stage, and that was the philosophy. And since that major kind of these kind of companies are available mainly into small and mid cap segment, so we have major exposure into small and mid cap companies only. So it is of course bottom up approach, and uh, all the research things happens. We are a team of 6 people who are dedicated into research, and total team of 14 people. So then we identify, we make the management, we understand the valuation, what is the valuation. So there are two elements. One is growth, another is value. So growth, you have, growth can be on few things. Like we understand that there can be growth of top line, margin expansion is also considered as a growth. Whether it is sustainable, it is not sustainable, quality of the growth. When one company, a pure wire and cable companies, are growing because of growth in FMEG company, or because of their FMEG segment, electronic goods segment. So we understand that this quality of growth is very good, and then we apply our valuation metrics, that whether it is a comparable, it is compared to its peers, its industries, and then of course then there is some element of conviction. So that's how the company is selected.
So, when you talk about price, how do you know that this is the correct price? Because that keep changing, and this is something all our viewers wants to know from you.
Huh. So, so as I said, there is of course some element of conviction first. Second, we don't do that bottom fishing kind of thing. So what we see is that from I am sure everyone is aware about PG ratio. So when you know that your growth is coming, where growth is coming, and then you discount it with current price and current moment, then we understand, okay, then risk reward ratio is favorable. Then we find, and then we invest. Then there are some
The kind
trends
of
also
metrics
where
that
we,
you look at.
yeah, and then there are trends also like we want to follow. We started investments into pharmaceutical. We wanted to have some exposure into pharma companies. In early January 2020, we already decided that we wanted to have some exposure into pharma companies. So we did some top-down analysis, and we found some good companies, Cipla and other things, and we had investment. So it is mix of everything. So it is price, of course, and of course then we know that, okay, now everyone is aware that currently commodities like steel, cement are doing well, and if we find some good opportunity there, we will invest. So
So, do you
price,
also
maybe
try
price
to,
is a subjective. Yeah, yeah,
yeah, sure, sure. So, do you also try to look at cycles, because during this cycle your pharmaceutical companies have done well. The
yeah.
previous cycle, all the large cap companies have done well.
Yeah,
So, how
part
do
of the portfolio is you can consider as a cyclical. Like currently, also we are very bullish on agriculture, agrarian commodities. Okay, so we have sugar in it, we have basmati rice in it. So yeah, so there are cycles, but we don't compromise on our fundamental analysis. We don't compromise. So there may be more than 25, 30 large pharma players. We invested only in two. So we don't compromise on the fundamental. We understand where the value will come from, and so yeah, we to answer your question, yes, we have investments into cycles also, cyclical companies also, and some, as I mentioned, right now also we have sugar sector in our radar. But because what we look for the sustainability of the cycle. So when we started investment into pharma, COVID was of course was one of the reason. But what we observed was also that FD approval now was becoming smooth. Some large expansion was happening. Then the chemical supply was available now in India. and that cycle, that sector was into kind of a consolidation in last 3 to 4 years. So there were enough triggers. Okay, then when you have that FMCG is quoting at 100p and one large Indian pharma company having business into more than a century and quoting at 10p, so you know the difference. Okay, that this is the something that I will like to have investment. Similarly, in sugar sector, we found the ethanol story is becoming very popular in India, and government actions were government steps or actions was visible. We could
Okay.
easily visible, measurable, and it was very clear, very much clear. So we just went through that. It was very otherwise what was happened earlier, गवर्नमेंट को पता था कि मुझे इथेनॉल करना है, मुझे शुगर फार्मर्स को प्रोटेक्ट करना है, आई वांट टू प्रोटेक्ट शुगर इंडस्ट्री एज वेल, but it was not actionable. There was good thought, but it was now this point of time it was actionable. We could visualize, we could see the figures, we could see the changes in balance sheet, we could see the changes in data figure, we could see many things. So and then we just identified that okay, which is the most efficient player in this industry, and we invested.
Yeah. Would you like to run any presentation or any slide that
I
you
have prepared
show to
something.
us?
Let me share some of it. Uh, so this is something that you know. Is it now visible?
Yeah, visible.
Yeah, yeah, yeah,
You just have to go to make it full screen. Go to
yeah. Okay, sure. Right. View, full
no here
screen.
down. Yeah, yeah. This one. Left, left. Yeah, yeah. This one.
This. Okay. I'm sorry, I'm little
Yeah.
poor in all this
That's okay.
presentation. So yeah, so as I said, our strategy mainly focuses on growth and value. Okay, so growth in which part of the books, as I said, that it is top line, bottom line, margin expansion, whether what type of the quality of the growth. When you have the quality of growth, then you can visualize the valuation. I shared the example of one wire and cable companies where growth is coming from that FMEG part of their business. So the quality of growth, of course, the sustainability that I say shared about the sugar sector. When you know that balance sheets are improving, profit and loss are improving, and these are the government actions which are deliberated to make the companies profitable. So that sustainability is there, and of course, then the cash flow management that is most critical because growth is growth is some efforts, but when the output comes, then how cash is utilized. So that is the I think where management skills we have to understand about the management skill and other things. So that plays very pivotal role in the our identification of the companies. Uh, then there is of course the valuation whether companies are undervalued. uh, it is the PEG ratio I shared with you earlier. Then there is a re-rating triggers that I shared about the pharmaceutical companies. When the FMCG companies are quoting at 80 and 100 PE, while the pharma companies are quoting 10, 20 PE, and both are essentials, both are doing well, cash flows are well, they are, so so as well as the industry. The same and there is some of course some element of conviction that's where the expertise comes into play. That's where you need a fund manager because the, that is unavoidable. Because what I suggest is that something that I can share the slides. Yeah, that will work. I'm sorry, whether Vikas is there.
Yeah, you just have to scroll it down.
Yeah, yeah. But Vikas, can we go with the question and answer session, or I complete my presentation and then
Yeah, so we can
as and when
have
we
Q
feel
and
that
A.
I feel that okay, I can share the slide. I can.
Yeah, we can have
Okay,
a
okay.
Q&A
So,
also.
uh,
Uh,
so
so yeah, that makes more
so
sense.
that would work better. I think it will be more
Yeah,
interactive. Yeah,
sure,
yeah,
sure, sure.
yeah.
So let me make
Let's
an
have it more
announcement. So
interactive.
those who wish to ask any
Yeah.
question, please feel free to type their questions in Q&A box, and then I'll start shooting those questions to Arpit. Yeah, so till the time our investors are typing their questions. So one question from my side: how do you balance between growth and value? Because at times growth stocks do well, at times value stocks do well. So how do you manage uh, both of them?
So because it is not growth versus value. I want both the things in the same portfolio, in the same company, in the same portfolio. So normally that people believe that okay, these are my growth stocks and these are my value stocks. We don't discriminate between the two. I want a growth stock, that is for sure, but at my valuation, at reasonable valuation. So all the companies that we have in our growth plus value strategy, and that is our where major funds are parked. So that companies are having growth as well as valuations are in our comfort zone.
First question comes from Harsh. How do you do management check and forensic accounting check?
So for forensic, of course, the cash flow is the best tool. When you understand, you go through the cash flow of the past 2 3 years, how company has managed. Then of course that is the best tool to manage the forensic accounting. Then ratio of independent directors, the profile of the managing director, whether they are promoter driven, they are individual driven, those are the few checklist that we have to have our audit uh, perfectly.
See, management is a very subjective thing. So how do you look at that? What are things
Yeah.
that you undertake in terms of activity
Uh,
within your organization before you're very
okay.
sure that okay, you are investing in these companies? For example, there is company called Manpasan, which was like everybody was investing in those companies,
Hmm.
and
Correct.
all the
Correct. Correct.
investors
Correct.
got disheartened with the fact that there was a big fraud in the
So
company.
yeah. Okay. So let me share one example without naming the company. It is into packaging company, UP based company. Okay. They have identified replacement of that thermocol into tableware segment. The story was very good. They installed their plant. Uh, what lately happened that company started making the presentation. So their top line for the year 1920 or even 2021 is somewhere around hovering around 200 crores, 220 crores or something like that. They say that they will now expand with the capex. They have come up with the capex line is that you understand that cash flow is hardly 10-15 crores that they are making. That still they are going for the expansion. They installed their plant in 2000, I think 19. They started running their plant, and till date, it is running only up to 50%. So they are announcing expansion, but their current utilization is less than 50%. Okay, they are making, they are not making any money, so they are not making any profit of that out of that segment. They have some other segment of packaging which is fluctuating, but they are not making money into this segment. And only on whole capacities, current capacity is 60 crores fixed assets. Then when we go deep into management, so 95% of the management holdings is pledged. Okay, and then they have deferred dividend payment. I think I have come across in last 15 years, I have come across only one company which has delayed the dividend payment. So they announced in March, they delayed in June, they delayed in September, and September SEBI did not allow them to again delay, and then they make the payment. So this kind of the companies and management, when you meet the management, management went even to FedEx and not FedEx, that what we call TEDx. Sorry, I'm sorry. Apologies. So TEDx, and you see all the presentation, you find that okay, yeah, this is the next boom cycle, that is the next great cycle. But this is how you have to discount the that rosy picture. Uh, then of course when you go for the management meeting, you have to discount what is his role. So when you have professional management, their revenues are linked with the growth in the figures, of course. And when you have the promoter owned company, then their interest is increase in market cap. So you have to understand both the things, that how what is the reason behind their giving this kind of guidance. And then you have we go to the channel checks. We for majority of our companies, we do channel checks. We understand whether whatever management is saying that okay, my product is price, I'm superior pricing power I have, whether it is on ground, it is there or no, that we do channel checks and other things.
Okay. I just wanted to ask all the viewers, is there any lag that you are finding it, or it's only me who is finding it? I mean, is Arpit is fully audible? Any issue that you're facing? Because
Is
I
there
think
any
the
issue
voice is not coming to me.
connection?
Yeah, he's audible. Okay, perfect. Thank you, Dikhav. Uh, uh, Anybody else just wants to confirm so that we can go ahead? Are we audible?
Uh,
Okay, great.
Let me shift.
No, I think you're audible, Arpit. We can go ahead. Okay, the other question
Okay.
is from Mr.
So yeah,
Agrawal.
yeah.
He's trying to know that how do you do asset allocation for your own family office money? While you have invested most of your money in your PMS, but how do you do the asset allocation, shifting from equities to bonds and debt
No,
and
no.
other
So
asset?
honestly, when you said that, I'm a risk appetite is high, so that terminology actually, it is created because I have only exposure. So I have my own house where I'm staying, and then all my assets are into equities only. I don't have anything else, anything, not a single. No, I'm not even having that, gold, neither bond. So
The
that
entire
kind of
family of
exposure, and that also into mainly into small and mid cap companies. So where I find value. And as Rakesh Jhunjhunwala recently said that he won't mind even keeping his wife's Bengal, to invest into equity. So same is with me. I am very aggressive investor, and my family assets are into this only equities.
Arpit, if you could switch your internet from broadband to your
Give
mobile.
just give me 2 months. Just give me
Yeah,
a moment.
yeah. Yeah, there are few investors who are complaining that you're not audible fully. Yeah, so inconvenience is highly regretted. I think Arpit will take a minute and come back. So please bear with us.
I think this should be clear now. I'm very near to my now Wi-Fi connection.
Okay.
Yeah.
Yeah, it's better than last time.
Okay.
All right. So you are saying that you are 100% in equities. So, Hitesh, I hope you would have got the answer that, you know, as far as his family office money
Yeah.
is concerned, they are 100% in equities and they don't follow the asset allocation.
I'm sorry.
Okay.
Just a
So can you explain how your portfolio got corrected in dynamic time? Also looking at a great dip where market fell down by approximately 1,000 points. What will be your take on the markets at this point of time? A and B. The second question from my end is, what are the risks which is involved in the market at this point of time?
Okay. So first question is about the correction. right? So how do I take? Let me take the second question first about the risk. Risk according to us is that risk comes when you don't know where you are investing. So if you have done your research thoroughly, then there is only time lag which may arise. So if you feel that okay, you have some company can grow at this level, or it can be re-rating candidate, or growth will come from this level. So it may be 1 or 2 quarters here and there. So that I don't consider as a risk. So for me, risk is only when I don't understand where I'm investing, or I'm just following the crowd. So that is one thing. Now about the correction, I think volatility will remain in the market. It is there. It will remain as and when more participants comes, as and when economy is becoming more dynamic. It will be there. So our call is that we remain invested during. I can share the one slide here also in of our performance. So if you see, we started in 2011 uh, till 2017. We were delivering net of all the fees and expenses. We were giving 34% CAGR returns. Okay, that time also we were fully invested. When that CAGR went down to even that around you can say around 12-15%, that time also we were fully invested. And because of here, when we were fully invested, when the rally started, you know coming up again, rally started, now our growth is again is back to 19% CAGR. So I think that remaining invested is only thing that we follow. When you know good companies, COVID like situation arises once in a decade. It cannot be ignored as well, but it cannot be predicted. And I've seen among my clients also, and I've seen many investors also, that whoever wanted to time the market have always failed. Have always failed. What we have learned and that we implemented is something that from last correction is that we our portfolio is more diversified. Earlier we used to have around 5 to 7 companies having more than 70% exposure. Now we have more diversified. We are having around 9, 10 companies where we have around 60, 70% exposure and total portfolio of 20 companies. So that one thing we have implemented. Rest, I think that investor has to ignore that volatility and just give time to the money to make the money. I've read somewhere. Of course, it was WhatsApp forward, so cannot be authenticated. But missing a single day rally can have a dramatic impact on the your returns. So that chance I don't want to take. I can share one more example. Uh, uh, See, this company is HI Limited, where we are holding around 2% equity of this company, and it is part of our portfolio. We started investment somewhere around in 2018 when it was on our radar since 2016, but then management changed and we like the current management Dhirup Chaudhary. We started investment at somewhere around 2000 rupees in March 2018. Then there was a COVID fall and it price went down up to say 500 rupees, and till 1st February 2021. So almost after 3 years, uh, price remained at 2000 rupees. What we were observing was that okay, that earnings are growing. When 128 rupees trailing earning is now 150 rupees, 175 rupees, and March was predicted somewhere around we expected 250 rupees. Company's top line was growing, and it took only 15 days. So from 1st February to 15th February, when company grew by delivered about 65% kind of returns. Okay, so मेरा पूरा 3 साल का waiting period was rewarded only in 5 to 7 trading sessions. So for me and as an investor, you have to give time. If your story is playing out well, if you know that your company is growing, then you have to just give time. and don't try to time the market.
There is an interesting question which has come from Mr. Milind Shah. He wants to know the benefits of investing in PMS versus mutual funds.
Yeah. So I think because that is your question actually, because you have to answer. So see, basically PMS, one has to understand that you need an expert now. It is when you are investing big money. I understand everyone has very hard-earned money. So when you are investing big money, your hard-earned money, then you can't just take a casual call. Market and economy both are very dynamic. Every day something changes, uh, which needs to be monitored. So that is one of the main reason when you need an expert. It can be PMS, it can be, but you need someone dedicated to look after the situation or things are happening around the world, and which can have direct or indirect impact on your investments. So that is one of the reason. Second reason, one can say that when people invest, they probably try with the trial and error. When companies like us has a decade of track record, so that is something, why you want to have a trial and error when you have a experienced person. The third is that the people like us who are dedicated into PMS, our major revenue, I would say more than 75 or 80% of the revenue comes from the performance. So, so that the sport is on my neck to perform. Okay. So that is one. And I think that emotional behavior, when you want to book losses, when you, just a moment, I'm sorry. I'm sorry. So I'm absolutely sorry. So emotional behavior plays a very big role when when you manage your own fund and when you are responsible fund manager. There is a difference when where we never shy away from booking losses where our call went wrong, which may be a case for the individual investor. They would be little reluctant to book losses, and that I think everyone's observation is. So these are three, four reasons when you need an expert instead of managing your fund money on.
Sure. So just to add what Arpit said, see, look, first of all, let me accept the fact that mutual funds sahi hai. No denying on that. But we are also strongly building up the case for PMS, and we are saying that even PMS be sahi hai.
Mm.
And one of the reasons that we say PMS be sahi hai is that if you look at this industry, PMS industry is now shaping up well in India. There was a time when there were very few portfolio managers who were running the PMS strategies. The industry was not so structured those days, and there were not proper regulations to follow. Now, thanks to the regulator now for bringing in a lot of new rules and regulations like mutual fund, this industry is getting structured and shaping up well. Good quality portfolio managers have been entered in this business of late, especially some of the large names like, for example, Sunil Singhania from Abacus, who used to run mutual fund business for over 25 years, started this PMS business. You have Kenneth, many more large portfolio managers, Saurav Mukherjee, Marcellus, who have started A. And let me just take a minute quickly to tell you the difference. See, it's like this: you have, Ola app in your mobile, and all of you are using it. And when you use it and say you want to go to airport and it takes 30 minutes time, you have an option that you can either select a pool option, and you can have a separate car, sedan. Now the difference is that if you take 30 minutes to reach and there is a traffic in between, everybody is going to take time. Everybody will go to the same, use the same road, and everybody will take the same amount of time. But it is on the investor to decide whether they would like to share the car and get into a pool car, or you would like to have a separate car and access to internet and listen to beautiful music. So the difference between mutual fund and PMS is, in mutual fund there are a lot of investors, they come, and during the bad times they exit from the portfolio, mutual funds. And what happens, because of their behavior, your portfolio gets impacted. Whereas in PMS, all the stocks are held on your name. all the dividend comes to you, all the appreciation is yours. And if you have high conviction ideas in your portfolio, and if you have conviction in Indian equity markets, then you don't have to worry about. So somebody else's behavior is not affecting your investment behavior. So that is number one. As far as technical differentiation is concerned, I don't have any favorites per se. So as far as technical difference is concerned, in mutual fund you cannot have more than 10% exposure in one particular company or a sector, whereas in PMS you can have as high as 15-20% exposure in one particular stock. And it has been observed that most of the time the wealth is created when you have concentrated portfolio. I mean, you would have heard Mr. Rakesh Jhunjhunwala making 80% of his wealth coming from one single stock, which is Titan. And you would have heard Mr. Ramdev Agrawal made good amount of money from stock called Hero Honda, which he held on to it for over 16, 17 years. So again, there is no comparison, apple to apple comparison between mutual fund and PMS. But of course, each of them have their own advantage and
Because
disadvantage.
one point also can be attended that here like people like us who are fund manager are can be accessible or can be a personalized developed. Where mutual fund you that seems difficult unless you have very large amount of investment. So that is something that that is also that matters the most, because when market is going down, when you things are every day, your portfolio is going down by say 5-10%, you need someone to at least give you a hand holding that okay sir, this is the market, but these are the companies and these are the fundamentals. And when personalized connection or one-on-one connection is there, so it gives you a very comfortable kind of a zone where you can sleep calmly. You know that someone is taking care of it.
Okay, the other question is from Dhwani Parmar. And the question is, how do you suggest someone who wants to increase their risk appetite? And so basically, how do you look at that? How somebody can increase their risk appetite by investing in mid and small caps?
So increasing risk appetite won't work. You say that okay, I'm increasing my exposure more to equity, that means high you are taking higher risk. I think that is the only risk only. So risk is basically, you have to understand that uh, how do you define risk. As I said, I define risk as when I don't know where I'm investing. If that is the case, then I am 100% at risk. uh, Now about the allocation, about the equity or bond and other mutual fund or something, like if that is the question, then probably I would say that underlying assets are equities, then better to go with the PMS player or go for the direct equity if you can understand the market, then for the mutual fund. So
Okay.
lot of many opportunities are arising here in the small and mid cap segment. Indian economy is growing like will grow like more than 9-10% for next decade, and many MSMEs will be large companies. So that opportunities, I think PMS players are very well equipped and allowed to grab it. Even mutual funds may identify some opportunities, but they may, because of their size or because of their, their restrictions, they may not be able to have that exposure into their that fund. But PMS are there.
Yeah.
So, am I answer is correct, or
Yeah.
I'm, or you
Yeah.
want to
Yeah.
rephrase the question?
No, no, got it, got it.
If-
So, Dhwani, in case you have more questions, please type in, or you can elaborate what exactly you want to ask. So, next question is from Viral. Viral wants to know, in mutual fund holdings are declared on a monthly basis, whereas in PMS it is not. Any reason for the same? So let me tell you, in PMS the holdings are even reflected on a daily basis and not even monthly. So it is even more transparent than mutual funds. So in PMS, you can have a user ID password. You go to your own DP and have an access to all the portfolio companies that is bought by the portfolio manager in your demat account. So you have 24/7 access to your own portfolio, unlike mutual fund where it is declared on a monthly basis.
Yeah.
Okay,
So,
Mr.
the
Miller.
my question to the client is, the participant is that why you would want to look at the portfolio on a daily basis or monthly basis when you when you have after all the studies you have invested into either fund or PMS or somewhere, then just give them some time. Yeah, evaluate on a quarterly or yearly basis. Yeah, even quarter is shorter period, so don't look at the
Sure, sure.
holdings.
So other question is from Mr. Shah. He wants to: do you believe in buy right and sit tight, or chasing momentum?
Both. I am behind the money. Wherever I think I can make the money, I will invest. Let me share again the same
Yeah, can you
chart.
show some of your
Yeah,
large holdings as well?
yeah. So let me share this one. Okay, HIL. I was holding because I was confident. I was holding all 3 years. I am still holding. I have not sold a single share. Okay, so this is the best example of buy right and sit tight, and this is kind of a momentum which Acrisel we started investment somewhere in January, and it is already around double. So it gave around 75 to 80% return in last 2 months. There were many triggers which was coming up as a momentum. When the company already had 5 lakh sinks capacity, they announced 1 lakh more, 1 lakh more. So after completion of 1 lakh, again they announced 1 lakh. IKEA tie-up was there. Management was accessible, management was confident, and there were only this kind of only 4 players in the world. So it was a momentum call also, but still we are holding. Okay, right now we are evaluating some cement companies where there is a good momentum. So I think whatever is available to me, I will look into it. I want to make at least more than 20% CAGR, and if that is possible by holding 6 months, I'm getting 20%, or by holding 3 years, I'm getting 100%. My net average returns are met. I'm open for the kind of
Yeah, can you
investment.
show some more of some of your holdings, your top five holdings?
I have that sector specific exposure.
Yeah,
So
and that will be great.
FMCG and staple foods. So staple foods we have Dawat. Then we have, as I said, Balrampur Chini. We consider this as an essential. So these are the companies. Then we have paper and packaging. Paper we have JK Paper. Packaging we have Cosmo Films. Uh, there are many triggers like Cosmo Films. When we started buying, management were offered for the buyback. Management did not participate, so that shows the confidence of the management. And then things, all this commodity cycle went dramatically well in our favor. So that pharma, I said in my opening statement only, we were having around 15 to 20% exposure. So because other companies moved well, so it is coming down. But we are having around 15 to 20 in that. We have Cipla, we have Alchem, we have Alembic Pharma, FDC is there. So those are the companies. Construction material is HIL and then Acrisil. That those two companies. Chemicals, we have Manali Chemical. That is also very interesting story. If one wants to understand, I will share it later. But chemicals, Manali is there. Thirumalai Chemical is one, which is a pen manufacturer among the 7 in the world. Fertilizer, we have Chambal, we have uh, I think Coromandel, we have, and there are some other companies also which are into manufacturing like VST Tealers. Those are the companies.
Okay, great.
Vikas, just want to make a disclaimer that I personally own, and Care PMS also has all the exposure into the companies that I'm referring to. So just because I think that
Yeah, yeah.
I'm sharing my experience and I'm also having exposure to those companies.
Yeah. So I would advise all the participants not to invest in these companies before taking their advice
Uh,
from their
they,
financial
yeah.
advisors.
They at least make sure that we are invested, so we may have exit option. We have some exit strategy also, and so just to make a disclaimer that I am
Yeah,
personally also have invested into all these companies.
sure. All right. Great. So I think it was pleasure talking to you, Arpit. Good to know
Thank you.
the views of your house in terms of markets, in terms of the stocks
Thank
that you bought, your selection
you.
criteria.
Thank you.
Anything
Because
more to add?
two things, yeah, I want to add two, three things. One is that people are still little worried about the timing, that whether it is a good time to have exposure into small cap. So what I see is, since 2018 when small cap picked up, okay, then there was a sharp selling and it went down up to 50% uh, in March 2020. Then it has just reached to its earlier peak. While the Nifty has already crossed that lifetime high, and Nifty is quoting at its lifetime high. So I feel there is a lot of steam is left in the our segment, and next 2 3 years there are great opportunities. And in 15 16, we delivered around 100% return. After that, next year we delivered more than 70% return. Similarly, this year 2021, we are up around 117%. But I'm still quite confident that next year can be more promising. 21, 22. We have discounted COVID and everything. Then also I feel that this is not the very high market to enter into. Uh, One of the reason for this is this, when well, our weighted average PE currently it is uh, 16, somewhere around 16 times, while the even Nifty is 33 times. So I think those are the cases where you can see that value will unlock. Liquidity is there in the market. People want to invest into market. We have very good FII interest. So there is a lot of steam available. It is left where we can make very good money. So that's from my end. Yeah, thank you. Anything else that you would want to ask or?
No, so if there are no more questions, Arpit, so thank you so much for
Thank you,
taking
thank
the
you.
time out.
It was my privilege to be here. Thank you very much.
Yeah, I also take this opportunity to thank all the participants for joining in today. Thank you so much. So we'll keep organizing these knowledge-based sessions again. So thank you so much.
Thank you very
Thank
much.
you.
Pleasure.
Thank
Bye.
you, Vishal, for helping us and Emmy for helping us.
Yeah, my team, Vishal, my research team, people who helped me to prepare these slides. Thank you very much.